Hello trading friends and welcome back to Forex Focus, brought to you by IG. Taking a look at the chances of not necessarily even Fed rate cuts, although we will take a look at those likelihoods, but if the Fed might hike interest rates again. Yes, it is indeed 2024 and we're still talking about interest rate hikes from the Fed as a number of data points have turned around in the US in recent weeks, and a number of markets. The stock market has turned over from all-time highs. US dollar is on the rise, and US interest rates across the Treasury curve and Fed funds futures are moving higher. We'll cover all of it. But first, I want to cover the context. Why would an interest rate hike be interesting at this point in time? I mean, they've hiked from 0% post-pandemic to above 5% to combat high inflation rates in the US. And so why would another hike to interest rates be interesting given that backdrop? Well, if you've been tuning in recent months, pretty much since October, November of 2023, the party line from the Fed has been, we think we're done with the hikes and we're looking at cuts. And Fed Chair Powell, as recently as in the last month, has come out and said that they're looking at rate cuts at some point this year. And the reason that he had to point out that they're still looking at it at some point this year is because U.S. data has been so strong recently. And we'll get to that in a second. But you can see here from the most recent FOMC meeting, we have the dot plot, which is essentially a distribution of where Federal Reserve central bankers think that interest rates will be, the overnight rate that they control, the Fed funds rate, if you will, where they think it will be at certain points in the future. And right now, it's at 5.25% to 5.5%. And so if you look at that leftmost column, you see in 2024, the focus of the distribution for this year is actually below 5%. So factoring in potential rate cuts at some point this year, to borrow words from Fed Chair Powell. And then you go out to 25 and 26, and in the longer run, all of the projections are pretty much lower. And you can see in the longer run, central bankers thinking that interest rates in the U.S. should get down to the 2 to 3% range. Okay, sounds great. That's where the projections have been. But U.S. economic data has told a different story. Inflation back on the rise in the U.S. The most recent reading was higher than expected, and it was the second monthly uptick to the inflation rate in a row. And keep in mind that central banks tend to want inflation, and the Fed is targeting a 2% inflation rate. And so essentially not 0% or deflation, but not as high as it's been in recent years. They don't want it, 5, 6, 7, 8%. Plus, they want it right there at 2%. We haven't been there in the last couple of years, and it looked like we were on that trajectory to get down at least into the 2 handle and close to 2% even. Recently, you've had the upticks to this U.S. data, and now the fear is if inflation might take a second leg higher here. And I want to bring in historical inflation. We have here the last 100 years of inflation for you from the U.S. Bureau of Labor Statistics and Trading Economics. And I thought something really, really interesting, because so many case studies being done in the last couple of years around the spike in inflation that we've seen in the U.S. and that they've seen globally. The Euro area, the UK, Australia, Canada, a bunch of major economies hiking interest rates in the last couple of years to fend off high inflation rates. And you can see amid this spike, we saw some of the highest inflation rates since the 70s and 80s. And so much work being done to take a look at what was going on in the 70s and the 80s. And what was of particular interest to me, especially in light of some of the recent data that we've been getting where inflation has upticked once again, and this is against the backdrop of the last year or two, it's been a pretty consistent move lower. You see there from the peak of that inflation spike where we got to, I believe it was 9% inflation year over year. It's been moving lower from 9 to 8 to 7, 6, and on to 3% recently, and now we're getting this uptick. And so I'm like, is there a historical case for there being, spike to inflation? Central bank comes in, raises interest rates, calms down that inflation, and then they start to plan the soft landing, so to speak, and inflation resurfaces. And the last time inflation was this high, we actually did get those two separate spikes. And if you were trading in the 70s and 80s, you definitely remember this, that you got the first initial spike in the mid 70s, and then inflation comes off to the late 70s there. And then in the early 80s, another leg higher to inflation. And so definitely a historical basis for this idea of, you don't just have to see the inflation spike, they raise interest rates, and then inflation comes back down to 2% or 0% around where it's been for the last 20, 30 years. You can get this resurgence in inflation, and this could be the start of such a resurgence here. A couple of things worth noting in terms of how interest rate markets are reflecting this fear of an inflation second wind, so to speak. We're now, for the first time in months, getting a pretty significant chance of no rate cuts in 2024. And you might say, well, Frank, you led the segment by saying, could the Fed hike interest rates again? And I'm telling you that this is some of the most hawkish, or potentially leaning on another second wind to rate hikes that we've seen really since November, December of 2023. Because in that time frame, they were pricing in 5, 6, or even 7 rate cuts for 2024, effectively bringing the U.S. interest rate from above 5% down below 4%. Now you fast forward to April, and the first quarter of the year, you've seen this U.S. data either continue higher in employment and a bunch of other facets. GDP growth still strong, and now inflation starting to tick higher again. And now they've priced out those 6 or 7 rate cuts that we saw at the end of last year, and now the bulk of the curve is around 1 or maybe 2. You can see there about 70%, close to 70% chance that they just cut once or twice, and that's in from 6 or 7 times a few months ago. And a few months ago, there was a 0% chance, the futures market was pricing in a 0% chance of no rate cuts in 2024, and now that's up to 12%. And so it might still seem relatively small. They haven't started pricing in another rate hike, but I mean, at this pace, it's only a quarter of the way through the year. They've gone from 6 or 7 cuts to maybe 1 or 2 or maybe none. You could see that if inflation ticks higher to 4% or higher than that, get back to the highs that we saw 2 or 3 years ago, the Fed could get back into a hiking environment. Because even though Fed Chair Powell says they're looking at cuts, his rhetoric and the central bank and their activity can change on a dime. They're constantly watching this data and what's going on in the market. Another piece to take a look at here is the stock market's reaction to this, because we've seen these projections for interest rate activity from the Fed shift so many times in the last 5 or 6 months. Like I say, we got to potentially 6 cuts. We've now gotten all the way into 1 or 2 cuts here in 2024. And all this time, we haven't seen any interest rate cuts, obviously. But the projections have shifted. And what's interesting is from December until now, the interest rate market has pretty consistently priced out, 1 cut at a time, going from 6 to 5 to 4 to 3 to now 2 or 1. And the stock market has had, plenty of small reversals off of all-time highs, but has really stuck to all-time highs and traded through all-time highs amid all the changes in interest rate futures and projections for this year. But this is the first time the last really the last month since the March FOMC and since we've seen another batch of strong employment and strong inflation data, the S&P is starting to move a little bit off of its highs here at the end of March and start of April. And we'll see if this continues into the middle part of the year, because another market that we're seeing trend in a new direction amid this U.S. interest rate strength and the potential for less cuts and maybe even no cuts or a hike or two if inflation continues higher, is this U.S. dollar. U.S. dollar is now trading above 154 against the yen. That's the highest level since 1990. So U.S. dollar is through highs against Japanese yen. Euro is back below 107, pound back below 125. Now, those aren't multi-year highs for U.S. dollar in those forex pairs, but those are pretty recent highs for U.S. dollar. You'll remember, of course, euro traded parity a couple of years ago amid the interest rate hiking and inflation fear and everything else. And in the last year, the low has really been 104, 105. And so to trade under 107 in that market, pretty strong U.S. dollar there, and strong U.S. dollar really across the board for the last several months of trading. And so all these markets starting to really listen to this potential for either fewer than expected rate cuts or no rate cuts, or the potential for a hike if inflation continues higher. So is the Fed done hiking? Fed Chair Powell has said yes, but the inflation data is starting to say something a little different.